Assalamu alaikum warahmatullah. So, dear participants, in this video, we are now starting IOFI Accounting Standard number, Financial Accounting Standard number 32, which is the standard for Ijarah, accounting for Ijarah, which is the lease in Islamic finance. So, in this particular video, we are actually covering the definitions, 31 definitions, which have been provided in the initial part of the Financial Accounting Standard number 32. So, let's do. So, this presentation, particularly, I have developed it on a notebook, Google's notebook, and this is the beauty of this particular tool that it actually classifies these definitions into their thematic categorization. So some of the core framework definition which constitute the contract of Ijarah, what the Ijarah is all about, then the control and the parties, type of assets, some of the different variants of Ijarah, some rental types, and then finally the accounting terms. So the contract we already know, it's an arrangement between parties where there is a legally enforceable right and obligation. And when it comes to Ijarah, how does the standard defines it in 4L, definition paragraph 4L, which is a contract or part of an arrangement. Why it is said it is a part of an arrangement? Because the arrangement can be Ijarah plus gradual transfer of ownership. So these are two different things, right? So the arrangement can be broader than just Ijarah. So a contract transferring the usufruct, which is the usage benefit associated with the use of an asset, of an underlying asset. So these are the two terms which we will come across within the same presentation. What is exactly the usufruct is defined, and what exactly the underlying asset is defined. How exactly the underlying asset is defined. So for a period of time in exchange for an agreed consideration. So this is the lease agreement which the standard has defined it in terms of Ijarah. So there are three core say pillars in the definition of Ijarah which had to be there. Number one, it has to be a contract. It means there is a form and an acceptance. There are parties. There is a lessor and lessee, right? Muajir and mustajir, basically, but the standard does not use these Arabic terms. It uses the term lessor and lessee, and the object is the transfer of the usage rights of an asset, and in consideration there is some receipt of rental on the part of the lessor. Then the usufruct has been defined as a legally enforceable limited right related to an asset, right? So this is a right for a usage of asset, retrieving the benefit of an asset, but it is a limited right. So it does not establish control of an asset. So if we recall our earlier discussion in the Murabah standard and the framework of the IOFI accounting standards, that an asset is recorded as an asset when the party recording as an asset has the control of an asset. So we have not full control because not all the risk and reward are transferred. So strictly exclude the risk and rewards incidental to physical ownership. So physical ownership is not the right word. It's the right word is ownership. So still we should not rely 100% on notebook, right? So the standard mentions the ownership word. So it means that we can use the asset. We can, if I have bought a vehicle on Ijarah, then I can make use of the vehicle for the purpose of my transportation of goods, or maybe for travel purpose, but I have no control in terms of all the risk and reward of that particular asset. So if the market price of the vehicle increase, I do not benefit unless there is something else also included in the contract along with the contract of Ijarah, which is eventual transfer. We shall see in the subsequent slides. And again, for example, if something bad happens to the vehicle, right? So as per the very contractual terms, it is the loss of the lessor, not the loss of the lessee, theoretically, right? So the rights associated with the use of assets have been transferred, but the rights associated with the ownership of the asset have not been transferred. So that's known as actually the usufruct, right? So now this means that that's why eventually we'll see that we do not record a leased asset, an asset under Ijarah, when we take an asset under Ijara, we are lessee, we do not record as an straight asset, we record as a right of use asset, right? And this standard actually mentions that's an intangible asset, right? Although this is not a standard term in terms of IFRS treat it as a sort of in line with the tangible asset under all the depreciation rules apply, but this standard treat it as an intangible asset anyway. So then the definition of the lessee and the lessor, a party that acquires the usufruct of an asset, underlying asset, right? So the assets, which is the subject matter, the physical asset, which is the subject matter of the Ijara contract, is underlying asset for a period of time in exchange for an agreed consideration, right? And a party that transfers for a consideration. So this is the lessor and lessee. I think there is no confusion in this. Then the threshold of control, again something that we have already gone through, that when we used to say that somebody controls an asset, right? So when all the risk and the reward are held with that particular institution or entity, and this happens when exposure to the variable returns and power over the returns, so the governance power to affect the returns. So these two are there in order to establish the control of an asset, which is not exactly in the Ijara contract. In the Ijara, the power to govern the returns actually mostly rests with the lessor, and the usage benefit actually passes on to the lessee. So underlying asset is the subject of the Ijara contract, the asset which is the subject matter of the Ijara, for which the usufruct has been transferred by lessor to lessee. And the right of use asset is an intangible asset, right? So this whatever the right of use has been transferred, the standard terms it as an intangible asset representing a lessee's legally enforceable right of use or control of usufruct, right? Not the control of an entire asset, but the control of use of that asset. Of an underlying asset for the Ijara term includes combined assets, right? So right of use assets also includes combined asset. We'll see combined asset in the subsequent slide. So it happens when there are arrangement of gradual transfer of an asset or eventual transfer of an asset alongside the Ijara, which is usually the case. So what is a combined asset, right? So it is the proportionate ownership physical equity. So let me correct, right? A combined asset is asset which is at the same time there is some part of the asset belongs to the lessee and some part of the asset belongs to the lessor, and the part of asset that belong to the lessor is actually the subject matter of Ijara, and the part of asset that belong to the lessee is not the subject matter of the Ijara. So this is the asset which is this is the gradual transfer case, right? This is not the eventual transfer case. So intangible right of there can be an asset right for in which I own 20% and a bank owns, the lessor owns 80%, and eventually when I pay Ijara, some part of the cost that I pay goes towards buying the asset. So eventually my share increased to 30%, 40%. So this is the sort of combined asset, which is usually the case in the finance lease, capital lease transactions. So an underlying asset subject to Ijara MBT, right? Ijara Muntahina Bitamlik, we shall see further in the next slide, through gradual transfer or any other form of Ijara MBT in which proportionate ownership and right of use do exist simultaneously on the exact same asset. So if I take a car on lease from a bank on the terms that the car will be transferred to me after the expiry of 5 years by virtue of a gift or maybe a residual payment, then that asset during the lifetime of the Ijara is not a combined asset, right? Because it will be eventually transferred. It is not gradually transferred. But if an asset is gradually transferred, so on the day it starts transferring the ownership, it becomes a combined asset. So then the types of Ijara: operating Ijara, where the term is less than an Ijara that is strictly not accompanied by an option to transfer ownership of the underlying asset to the lessee. So very much equivalent to the operating lease in the IFRS. So where it is a simple rental of an asset, right? And a short-term Ijara, which is an operating Ijara. So it has to be an operating Ijara but it is short term in the sense that the period of time for which the asset has been given on rent on ijara is less than 12 months. So for example, usually the property which is given on rent is usually of this kind. There is no for example, the banks themselves, they acquire property on rent, or maybe any other party which any trader, any manufacturer which use an office on rent, it is not eventually transferred, the ownership is not eventually transferred to the lessee. So that's the kind of ijara which is operating ijara, and it can be of less than 12 months. So eventually, actually, why we are distinguishing these things, because eventually the accounting treatment for them differs, right? So then ijara muntahiya bitamlik. So ijara that ends, muntahiya that ends bitamlik, ends in ownership, right? So an ijara which is also supported by another contract, a parallel contract, right? Independent contract in which the ownership is also transferred either gradually or eventually. So a hybrid arrangement, the ownership transfer either after the term ends or in stages, executed via independent sale gift contracts, right? So these contracts have to be independent, right? Although of the critics of mainstream Islamic finance, they used to say that you cannot see any this type of arrangement without any executed any capital lease arrangement in which the lessee eventually does not acquire the asset, right? It's not economically feasible for them, so it is eventually for all practical purposes these are the incidental contracts, right? But from the Sharia point of view, since they are executed independently, so they are independent contracts, and this is what the scholars maintain. So diminishing musharaka ijara, which is a sort of muntahiya bitamlik, ijara muntahiya bitamlik, in which the gradual transfer is there. So a hybrid similar to MBT through gradual transfer is strictly comprising these three sequential elements. So what are the three steps? Number one, co-ownership. So shirkatul milk without common business intent, right? So I take the car from a bank as a lessee, I own 20%, bank owns 80%, but we have not common intent to do some business with the car and share the profits, right? So there is a co-ownership, but no common intent for business, for profits, for benefits. Promise by one party to buy the others as a share in periodic installments, right? So this is what happens in the diminishing musharaka transactions. I used to pay the rent for the bank's part of the asset, as well as I used to pay to buy the bank's part of the asset gradually. So my rent proportion, you will see in the detailed accounting part, my rent proportion gradually decreases, right? Whereas my ownership gradually increases. Why my rent decreases? Because since my ownership increases, so I do not pay rent on my ownership. I do pay rent on the bank's ownership. And finally, the ijara contract, where the lessor rents their remaining share to the lessee. So these are the three things together which make up the diminishing musharaka ijara. It's a sort of an MBT ijara, right? It's a type of an MBT ijara as per my understanding. So then there can be a forward ijara, all right? So there are of course terms and conditions on the basis of which this can be done as per Sharia standards, and eventually how it has to be taken into consideration for accounting purposes. So it's over here, right? So an ijara contract for an unidentified and potentially not present, absent, non-existent asset undertaken by the lessor to be delivered according to agreed specifications, right? So this is something which we shall see how the accounting, the AAOIFI standard FAS-32 actually advises how these contracts to be taken care of in terms of their accounting part, right? So these are within the Sharia limits. If they are undertaken, they have to be accounted for, right? And we'll see how they are accounted for. So for example, somebody can come up to the bank and ask that it wants a certain type of asset, for example, which the bank will first get to manufacture by means of some other vendor, for example, and then deliver it to the lessee on Ijara. Then there can be sublease as well, right? So sublease is an arrangement where a lessee transfers an acquired right of use asset to a third party. The original head Ijara between the head lessor and lessee remains fully in effect. So I have taken some asset on lease and then I pass on the asset to another lessee, right? So this is the kind of sublease, and this is something which is according to the Sharia protocols is allowed and then accounted for under this standard. Types of rentals. So there can be fixed rentals, there can be in substance fixed rentals, and there can be variable rentals, right? So when we say rentals, what is excluded? Any consideration paid or promised for the transfer of ownership, right? Any consideration paid or promised for the transfer of ownership. So for example, in the diminishing musharaka or eventual transfer, whatever amount I pay to get the asset, to buy the asset, is not part of the rentals. Lump sum ownership transfers, again the same thing. Gradual payment for equity, residual value guarantee. So these are all the same things which are covered under the very first start. So the Ijara rentals are the consideration due to the lessor from the lessee against the transfer of the right of use, and these are either fixed or in substance fixed or variables, which we shall see what are they. Actually fixed rentals are very much clear. These are fixed in absolute terms. In substance fixed rentals that may contain some variable part but are unavoidable, excluding conditions against ownership transfers. So the ownership transfer is already excluded, right, as we saw in the previous slide as well. So these can be variable at appearance, but these are in substance fixed. For example, the rentals can be KIBOR plus 2%. So they can be variable, but we know that there has to be a KIBOR and there has to be a KIBOR plus 2%, right? So KIBOR can be determined today's KIBOR, although the arrangement are 6-month KIBOR at the time of payment of lease or 3 months KIBOR at the time of payment of lease rentals. But in substance it is fixed, right? We know that has to be a KIBOR and there will be. But there are some variable rentals, right, which cannot be determined at the time of the inception of the lease. So the portion of rentals that varies due to change in facts or circumstances occurring after commencement, excluding the mere lapse of time, which are not actually function of time, right? So for example, I took an asset on lease on the terms that the lease term is not actually in terms of time, but it is in terms of usage. For example, I got a vehicle on the terms that I will pay per kilometer traveled, right? So at the time of the inception, it is not actually established how much I will use it. So that's the variable rental, right? Similarly, a CPI market rates, right? So how much the consumer price index will be? Will there be inflation or will there be no inflation, right? The market rates, what will be the market rate of the asset or something based on that, then that's the variable part of the return. Why we are actually differentiating between them? Because eventually when we recognize the leased asset, the asset under Ijara, we see that they have to be taken care differently. They have to be treated differently. And of course, something that we already did in the Murabaha, the security deposit, Hamish Jadiyya, it is a security deposit. And again, the important thing to note is that this deposit mechanism sits entirely separate from the ujra or the rental consideration. So the lessee actually gives usually some security deposit to the lessor. So that is a separate deposit. It is a separate contract, right? And that has to be shown as an asset. We will see in the accounting part. So the commencement date of lease of Ijara is not the contract signing date. It is rather the date on which the leased asset is available for use to the lessee. Now this is a key distinction, because under the conventional lease contract, usually the interest starts from the very date when the bank actually pays to the vendor. For example, it's a car lease, then when the bank actually pays to Toyota Motors, right? And maybe you get the car after 6 months. So actually these rentals starts from the very first day, right, when the bank has actually paid, because that's the interest. But in the Ijara, the rental cannot start unless the asset is available for use, for the intended use by the lessee, right? And the binding period is the time, period of time covered by the contract plus just the binding period. Ijara term is binding period plus some reasonably certain period, optional period. So for example, if the binding period is 2 years, but the terms of the contract are that if I use 3 years and eventually the asset will be transferred in my name, then it is reasonably certain that I will make use of this option, because this is economically feasible for me, and then eventually get the ownership of the assets. So this will be the Ijara term. Now, why we are to establish the Ijara term, including the optional periods? Because the asset has to be depreciated over the Ijara term, and the liability also has to be depleted over the Ijara terms, has to be paid off over the Ijara terms. So then the Ijara contract modification, if there is any modification, then that has to be accounted for. The useful economic life, it is the total period over which an asset is expected to be available for use, or the total number of production usage units expected to be obtained from the asset. So now there is a difference between the Ijara term and the useful economic life, right? So useful economic life can be in terms of kilometers traveled, right? But the Ijara term has to be in terms of time period, right? So Ijara term, so the contract can be that I have got a vehicle for a period of 3 years, such that I will pay not on monthly basis, but I will pay on the basis of whatever kilometers I have traveled over the entire life of the asset, right? So maybe I pay monthly, but not equal amount every month, right? But based on the kilometer travel. So that's the useful economic life, which can be the basis of Ijara rentals. The effective rate of return, a method allocating income uniformly and equitably over the expected benefit period. So from the lesser part, right, whatever rentals the lessor is earning, actually eventually we will see, just like Murabaha, that the returns will be spread over a period of time. It's not good to use the uniform term over here, right? Because the uniform, when we say uniformly, it is usually means absolute uniform. So it's not uniform. The rate is uniform, the amount is not uniform. So this is the term which is used as a standard. I think it has to be corrected. A method allocating income on the basis of time value of money, on the basis of effective rate of profit. So these are different terms which are used. Now this means that especially in case of diminishing musharaka, right? Initially, the bank owns more of the asset, the lessor owns more of the asset, right? So although the lessor is actually having the same amount of rentals every month, and every rental is not rental per se, every installment that the lessor is receiving will have some component of the rent and some component of the transfer of ownership. So initially the rent component will be higher because the higher ownership rests with the bank, but gradually the ownership component within every installment will become higher. So we'll see this when we will discuss the accounting part. And fair value, already we know that it is a value in the independent open market for a transfer of asset or liability. So then we have to be careful about the initial direct costs. Some of the direct costs are incurred by the lessor, some of the direct costs are incurred by the lessee. So these are the feasibility studies which are usually done by the lessor, the credit assessment of lessee which are done by the lessor, the contract execution cost, these are the lesser costs, right? So and then there are some deferred Ijara costs. So what is a deferred Ijara cost? We will see this in more detail when we'll discuss the measurement and recognition of Ijara in the next videos. So for example, I take the vehicle on lease from a bank, and it is agreed that I'll be paying a rent of 40,000 rupees per month. So 40,000 multiplied by 12, so it is 4,80,000 multiplied by for example 5 years, so it is 24 lakh. So 24 lakh is the gross Ijara liability, right? Now the value of my right of use asset is not 24 lakh, right? Because the value of my right of use asset has to be the present value of the future lease payments in terms of time value of money, or in terms of the asset, it is the value of the benefits associated with the asset. So for example, assume that after 5 years the ownership is going to transfer to me after all these payment of 24 lakh, then the actual cost of the asset, the fair value of the asset, is the value of the right of use asset, right? So whatever extra I'm paying is actually because of the deference of the payment, right? So that is the deferred ijara cost, right? So this is usually the interest part in the conventional lease. In the ijara, this is the deferred ijara cost. Why we say which is deferred ijara cost? Because we will see when we will recognize the asset, it will be recognized on the fair value of the vehicle. For example, the cash price of the car that I take on lease from the bank on 24 lakh, such that the eventual ownership will be transferred to me. The cash value, the current market value is 18 lakh. So I will record the right of use asset as 18 lakh. I will record the liability as 24 lakh, right? And the difference of 6 lakhs is the deferred ijara cost, right? Which I have to record on the debit side or the left hand side of the accounting equation. But again, we will see that eventually it has to be treated as a net from liability. In the recognition part, we will see it. So the resulting difference between the gross liability and the prime cost of the right of use asset, initially presented as a contra liability. So why prime cost, we'll see in the upcoming slide. So residual value concept has been defined for both lessee and lessor separately. So this is the value of an asset which eventually I will get when the lease period will expire for lessee, and it is the value which the lessor expects to get when the lease period will expire, the value placed on the asset. Net of expected disposal cost. So residual value of an underlying asset, the amount expected to be recovered for the physical asset at the end of the useful life, net of expected disposal cost, estimated at commencement date. So this has to be estimated at the date of commencement. Now these all things, some of the things might be confusing at this point in time, but these all will make sense when we will discuss the accounting treatment, the recognition especially, and the measurement under the ijara. So then the onerous threshold, right? So there can be times when some terms of the contract are explicitly unfavorable to one party. So that's known as the onerous commitment. A commitment in which the unavoidable cost of meeting the obligations under the contract strictly exceed the economic benefits expected to be received under it. So for example, I have taken a vehicle on lease, and after 4 years, 90% of the ownership has been transferred. The 10% is still rests with the bank, and somehow the technology has changed, and that vehicle is no more useful. But as per the terms of the contract, I have to pay for the 10% that the bank owns, the lessor owns. I have to pay the rent. So that payment of rent is no more giving me any benefit, any good amount of benefits. So it means that has to be recognized immediately. So the takeaway is that under FAS-32, again, this is not the purpose of this definition at this point in time. We will see it later in the accounting part, but what we will see later, an onerous commitment immediately triggers impairment recognition. So we have to record a loss immediately. We will see it in the details. So that's it. All the definitions, most of the definitions, not all I think, have been covered over here, and now in the next video we'll see how we account for the ijara by the lessee and the lessor in terms of recognition, in terms of measurement, in terms of presentation and disclosure, the 4 main assertions. Thank you.